Mike, we're talking rotation, market concentration, Republican sweep, it's looking like, how that could affect the rotation, and then Fed policy, of course.
Too much.
Hello and welcome to the Outlook by Capstrat. Let's get to it. The rotation is happening. What do we want to talk about here?
We've moved on from the period of Magnificent Seven exceptionalism, and the rotation started on July 11th. You can see it accelerated yesterday, the day after the election. Small caps, the big winner, up over 5% in many instances. So you can see now since July 11th, small caps at the top of the board up 17% compared to those Magnificent Seven stocks actually underperforming cash.
Yeah.
So the rotation continues.
Yeah, and that, of course, the longer the rotation continues, the stronger the rotation gets. Of course, begs the question, how is this here to stay? How much more room does this have to run? And, one area we want to look at, we've been talking about a little bit here, is market concentration. Mm-hmm. You can see this number increasing faster than the stock prices we saw on the prior page.
Yeah, one of the long-term factors that suggests the rotation has room to run. We already talked about valuations and the valuation discrepancy, how much cheaper the other 493 in small caps are relative to the Magnificent Seven. If you're going to sell high and buy low, you're going to be buying anything besides the Magnificent Seven. But the other thing that the Magnificent Seven have working against them, that small caps have working for them, is equity market concentration. We're looking at market concentration in the U.S. equity market since 1950. That's measured as you take the 10 largest holdings by market cap and you measure what portion of the overall U.S. equity market do they represent. And you have this surge in concentration heading up to a peak on June 30th of this year, with those top 10 stocks representing over 30% of the entire U.S. equity market. In terms of percentile ranking that, we got to the 100th percentile, the highest concentration we've ever seen since 1950. We're now off that high, but just barely. Yeah. We're in the 99th percentile. If you look at this data and you think about how does current concentration translate to future long-term returns historically for small caps versus large caps, that's the data we have in the table. When we get to a point where we're 75th to 100th percentile of concentration, as we are today, over the next 3, 5, 10-year time periods, small caps outperform large caps by over 3% annualized, just as the market starts to broaden out and investors sell high and buy low. And that's just looking at broad large caps and broad small caps. That divergence could be even greater if you look at, say, the cheapest area of the small cap market, like small value versus the most expensive area of the large cap market, like, say, NASDAQ 100 mega cap growth stocks.
Yep. Yeah. So we've got the rotation continues. Valuations and concentration give us reason to believe from a long-term perspective that the rotation will be here to stay. But a couple of potential hiccups, right? Especially near term. Namely U.S. election outcomes and the policies that could come with it. So we've had the presidential election called for Trump. The Senate elections have been called for a slim Republican majority. House elections not quite called yet, but looking like a Republican majority there as well. So what we have here are some of the bigger Republican policy implications and how they could impact the rotation going forward.
Yep, absolutely. The next 4 years in a Republican sweep scenario looks like it would be pure Trump 2.0. And that policy mix, break it down into 3 big segments: tariffs, tighter immigration, tax cuts. Specifically what would happen, yet to be seen. These are the broad strokes. Not all these boxes will be checked. But you think about the impact they're going to have and when that impact is going to be felt in the real economy. The first would likely be tariffs. If tariffs start getting enacted as President Trump has said he would like to do, we don't see any reason why he wouldn't start with that basically first day in office.
Right.
So that's where you would see it first. And we think of tariffs as a one-time boost to inflation. They're not an ongoing inflationary impulse, but a one-time shock. So we could be here in the February and March CPI and PCE reports, seeing something like a 10 basis point to 0.4% boost to inflation. how is the Fed going to deal with that?
Right.
We're trying to defeat inflation, and we get this one-time shock. That could create a lot of uncertainty for the Fed and a lot of uncertainty for others in the economy that are hoping inflation comes down. Then you start to layer in tighter immigration. It looks like those would be the next policies to be enacted. The translation of these policies of reduced immigration, potentially deportation, what that would look like, that would start to feed into the labor market by lowering the break-even number of jobs growth. We think about that as this is how many jobs the U.S. economy needs to create in order to keep the unemployment rate stable. You bring that down, what could happen is the unemployment rate falls. The labor market gets tighter.
Yep.
You could also see upward pressure on wages as labor supply decreases or the growth of labor supply decreases. And then finally, as we get towards the end of next year, that's when the 2017 tax cuts are likely to expire. We would expect those to be extended. We would expect those to be expanded in some ways, and then also looking to lower the corporate tax rate, at least for domestic manufacturers, yet to be seen if that's extended to all U.S. companies. The impact there is most likely going to be felt in fiscal deficits. Currently, baseline estimates assume that the 2017 Tax Cuts and Jobs Act expires. Yeah. And so that would boost tax revenues. If those are extended and expanded, tax revenues would decline, and you're looking at a higher deficit of about $1.5 trillion over the 4 years that Donald Trump would be in office. That would have an offsetting boost to things like economic growth and also earnings per share for companies in the US. But overall, you take this together, and what you get is throughout 25, a sort of pro-growth, reflationary, stimulative policy mix. And that is a potent mix. We saw the impact that had on the economy in 2016, but this is not 2016.
Yeah.
In 2016, there was slack. There was capacity in the economy to absorb this stimulus with few consequences. We think right now the economy is near full capacity, the labor market is relatively tight, and the economy is struggling to defeat the last mile of inflation. This could be a potent policy mix at the wrong time.
Yeah, and you take any of these three things individually, right? A short-term boost to inflation, a tighter job market, fiscal expansion. Any of those things would give the Fed a little bit more pause to cut.
Absolutely.
And we think it's pretty likely we're going to get all three,
mm-hmm.
right? So how does that affect how we think about the Fed's path from here? What have we done to some of these probabilities in terms of the landing scenarios we think we're going to end up in?
Yeah, we're going to start with the immaculate landing. The dream scenario, we've reduced that probability. We previously had it at 30%. We've cut that down to the historical probability of 20%. Looking back at advanced economy rate cutting cycles since 1960, 25 of which were inflation abating, 5 of which ended in an immaculate landing, 20% historical probability. We took that 10%, moved it into the no landing. Now a 70% chance of a no landing. Just a reminder of what that looks like. You got the cut today by the Fed. You get another cut in December. Once we get to January, now the Fed is entering a sort of new paradigm of increased policy uncertainty. They have said that they are not going to take into account anticipated policy changes on the fiscal side until those policies are actually enacted. They're going to be backward looking.
Yep.
So we think absent this 2025 fiscal stimulus that's likely to come, these Trump policies, take that aside, the U.S. economy on its own is in a relatively good spot and could accelerate coming into the end of the year. You tack those on, and what you're going to see is a Fed that is less likely to keep cutting rates. It's not going to be justified. They're going to want to go slower. They're going to want to see the ultimate impact of tariffs, of immigration, of tax cuts. And that's going to start by saying, we're going to pause, we're going to slow the pace. It might end in, hey, we cannot cut anymore.
Yeah.
Inflation is coming back. What they want to avoid is having to hike again. And how you're going to see them translate that into policy is they're going to cut slower and then eventually not at all.
Yeah. And they might cut so slow in Q1 that it does look like a pause,
Yep.
short or intermediate term. And so, with this probability moving from immaculate landing to no landing, looking at portfolio positioning or performance under those different regimes.
Mm-hmm.
Very different situations. I mean, on opposite sides of the x-axis here.
Yeah, exactly. Right now we're in the immaculate bumpy landing. You can see how productive of an environment that is for equities and bonds. If we move into a no landing, it's pretty much the exact opposite. Cash is king. You don't want to be anything near small caps or fixed income.
Yep.
So, putting all this together, from a long-term standpoint, the rotation has legs. There are long-term tailwinds to this from a valuation standpoint and an equity concentration standpoint. As we get towards the intermediate term, the outlook is going to start to get cloudy in 2025. The Republican sweep policy mix could be too hot for the U.S. economy to handle.
Yeah.
And that may start to pause rate cuts. Between now and 2025, it looks like equity markets have a green light, a nice sweet spot. If we're monitoring what could disrupt that between now and the beginning of 2025, the equity market is looking for the bond market's permission to continue to rally. What do we mean by that? If the 10-year yield stays below 4.5, if Fed funds futures continue to suggest cuts at subsequent meetings, and break-even inflation stays below 2.5, that's probably enough to maintain this sweet spot at least until 2025.
Yeah, and I think that speaks to the position that we've gotten into with, you've seen the 10-year rise significantly recently. You've seen 6 cuts come off the table in the past couple of months, 2025 cuts, and break-even inflation is rising significantly too in response to
We're getting close.
So,
we're getting close to those thresholds.
Certainly moving in that direction. So that will do it for this edition of The Outlook. If you have any questions or comments, please feel free to reach out.